Hi everyone, welcome back to my channel. Today we're going to do a financial modeling example of a fictitious company. Everything that's in blue is hard coded and we're going to use that information to do our modeling. So let's get started with our income statement first. Revenue for the base year is given as $1,000 and we're given the growth of revenue for the next 3 years to be 10%. So revenue for the next year would be $1,000 multiplied by open parentheses 1 plus 10%. I can press shift and highlight the two right cells and press Ctrl R to copy the formula to the right. Cost of goods sold as a percentage of revenue is 60%. So cost of goods sold is going to be revenue multiplied with 60%. Gross profit is calculated as revenue minus cost of goods sold. So revenue minus cost of goods sold is gross profit. And again, we can use the same shortcut by pressing shift, highlighting the right cells, and then pressing Control plus R. Operating expenses is given as $200. So EBITDA, which is the earnings before interest, tax, depreciation, and amortization, would be the gross profit minus operating expenses. Depreciation is given as 40 bucks. So earnings before interest and tax would be 200 minus 40. Interest expense is given as $20. So earnings before tax would be EBIT minus interest expense. The tax expense, the tax rate is given as 25%, and that's constant across the next 4 years or 3 years. So our tax expense is always calculated as a percentage of earnings before tax. So we do the earnings before tax multiplied with the tax rate to get our tax expense. So our net income is going to be earnings before tax minus the tax expense. Okay. So similarly, we can forecast the operating expenses, excluding depreciation. It's given as 20% of revenue. So revenue times 20%. I can spread that to the right. My EBITDA is again going to be gross profit minus operating expenses, which excludes depreciation. Depreciation, for me to calculate depreciation, it's as a percentage of property, plant, equipment, which means that I can't proceed further unless I have forecasted the PPE line item on the balance sheet. So let's go to the balance sheet and let's look at what we can complete out. So we're given cash, accounts receivable, inventory, PPE. So total assets is just a summation of these figures. We can use Alt equals if you're using a Windows laptop. Alt equals is a shortcut for auto summing. Liabilities plus equity, we have accounts payable as 120, debt as 300. Now the golden equation in accounting is that assets should always equal liabilities plus equity. Our total assets sum up to 950. Equity should sum up, total liabilities and equity should sum up to 950 as well. So if accounts payable plus debt is 420, it means that equity should be the difference between total assets and these two line items. So we can do total assets minus the sum of these two line items, close brackets, and then auto sum. And we get total assets equaling total liabilities plus equity. Now let's look at forecasting certain line items. Accounts receivable as a percentage of revenue is going to be 15%. So accounts receivable as a percentage of revenue. So revenue is this multiplied by the percentage of accounts receivable as a percent of revenue. Inventory is given as a percentage of COGS. So COGS multiplied by 20%. So these two line items we can forecast. Now we're going to forecast our accounts payable. Accounts payable is given as a percentage of cost of goods sold, 20% as well. It's a similar idea. So we're going to go to accounts payable as 20% of cost of goods sold. The cost of goods sold multiplied by 20%. And this is how we can forecast accounts payable. In this model, debt is assumed to be constant. So debt is going to stay at $300. So I can just link it with the previous cell, just put it to the right. So we got some things here. We got accounts receivable inventory and we got accounts payable and debt. So what are the missing line items? Again, equity is a plug-in, so we're gonna complete that once we get other line items. The property, plant, equipment. So the formula for finding the ending property, plant, equipment is taking the beginning PPE, adding capex, and subtracting depreciation. So I've given a small example here to think about this. Imagine you have an iPhone that's worth $100. You go to an iStore or Apple Store and get $20 worth of upgrades done. At this point, the value of your iPhone is $120. Upgrades is synonymous here with capex. Let's say there is your iPhone loses value of $10 every single year. That's synonymous with depreciation. So you start with $100, you get $20 worth of upgrades done. The iPhone loses $10 of value every single year. So the ending balance of the iPhone is 110. So the formula is ending PPE is the beginning PPE plus capex minus depreciation. So I've created a PPE schedule here at the bottom. The ending PPE for year 0 is the one that we have on our balance sheet. One thing to notice, all line items on the balance sheet are ending balances. So if in year 0 the PPE ends with the value of 500, it means that in year 1 it begins, the beginning value of the PPE would be 500. The capex, let's try to find information on capex. Capex as a percentage of revenue is going to be 15%. So I'm going to go here and say the capex as a percentage of revenue. It's going to be revenue multiplied with 15%, and that's going to be 165. Depreciation now is going to be as a percentage of PPE 10%. As a percentage of PPE 10%. So it's going to be the beginning PPE multiplied with 10%. And I'm going to make this number a negative, so I'm going to multiply with -1. So we have got the beginning PPE as 500. We're going to apply depreciation on the beginning balance that we have. And the capex is calculated as a percentage of revenue. So I can do the AutoSum function here, because beginning PPE plus capex minus depreciation is our ending PPE. So I can link this here, move these two cells across, AutoSum here. Again, like we got to make sure we get the correct values, and then I can highlight all these cells and control out. So this is our ending PPE, which we can now link with our balance sheet. So our PPE, which is a non-current asset, or a fixed asset that has a value that's going to provide us economic benefits for more than a year. It's a non-current asset, so we're going to link it with the value that we calculate in our schedule and move it to the right. So almost everything is done here, except cash and equity. So now we're going to complete out our cash flow statement using the indirect method, which is used by 95% of the companies. I have a video that I created previously explaining the direct and indirect method. So here I'm just going to focus on putting in the numbers, but if you want to go over the ideas behind how do we calculate cash flow from operations using the indirect method, please do watch my previous video. So we started with the net income. So we're not going to focus on year 0 because we're calculating for the next 3 years. We started with the year 1 net income. Okay, before that, now we can fill out the income statements. Depreciation, I'm just going to make it a positive number again because all the expenses are denoted as positive numbers. So let's keep the consistency there. So EBIT is going to be again EBITDA minus depreciation. I can spread that to the right. Interest expense is given interest on debt is 5%. So 5% of debt is interest. So debt multiplied with 5% will give us the interest expense. Earnings before tax is going to be EBIT minus interest expense. Our tax expense is again going to be a percentage of earnings before tax. Okay, so I can spread this to the right, I can spread this to the right, and that's done. Our income statement is now fully complete. So now we can fill out sections of our cash flow statement. So we start with net income. Net income is given here. We add back depreciation because depreciation is a non-cash expense. It's an accounting adjustment. No cash left our bank account, so we need to add back depreciation. And then we got to do changes in net working capital. Net working capital is current operating assets minus current, I'm going to move it a bit to the left here. It's current operating assets minus current operating liabilities. The formula for net working capital is accounts receivable plus inventory minus accounts payable. Okay, so let's do something. Let's calculate our net working capital for year zero. So net working capital for year zero would be our accounts receivable. So I'm going to put this in bracket. It's going to be accounts receivable plus inventory minus accounts payable. Okay, that's how we calculate net working capital. Let's calculate the net working capital for year one. It's going to be accounts receivable plus inventory minus accounts payable. So the change in net working capital, is going to be the difference between the year one net working capital and year zero net working capital. So it's going to be 165 minus 230. However, if you look at our formula for calculating cash flow from operations using the indirect method, it's net income plus depreciation minus the change in net working capital. Here, the change in net working, this is the formula, net income plus depreciation minus change in net working capital. Here, the change in net working capital is negative. But the end result of negative 65 is positive 65. So this is what we do as financial modelers. We do this. We do year zero minus year one instead of year one minus year zero. Because if I do it that way, the answer is going to be positive 65, which I want. Okay, so we're going to do accounts receivable plus inventory minus accounts payable minus, open parentheses again, accounts receivable plus inventory minus accounts payable. And that is going to give me positive 65, even though year one minus year zero gives me negative 65. At the end of this formula, when I put negative 65, it becomes positive 65. So that's what I want. Okay, then I can move it to the right. So my cash flow from operations is just the sum of these three line items above. CapEx is the only line item that we have in our model that's going to go in cash flow from investing. Okay, so CapEx is going to be this. And I'm going to make it negative because that's cash outflow. We're spending this money, so it has to be denoted with a negative sign. So it's going to be negative. So our cash flow from investing, since there's only one thing, I still would use the sum function. If there were other line items, which could be sale of land, okay, there could be minority investments a business can make in other businesses. That's called investment associates. These all would flow into cash flow for investing. We do not have any financing transaction here. This company pays no dividend, so there's no financing activity to record. So let's proceed. So our beginning cash balance. So what's the ending cash balance in year zero? Again, all the balance on balance sheet are ending balances. So our ending cash balance is 100, which means that for year one, the beginning cash balance is going to be 100. The change in cash is the summation of cash flow from operations plus the cash flow from investing. So ending cash balance is going to be the summation of the beginning cash balance and the change in cash, right? That makes our ending, again, it's like a corkscrew model where our beginning cash is the ending cash balance, and then I can move this to the right, and then I can do the summation here, and then again, this I can highlight and copy to the right. As you can see here, our cash flow from operations, which is from our day-to-day activities, is 169, 189. However, the cash flow from investing is negative 182, negative 200. So we're spending more money than we're making through our operations, which could be a negative signal So this is an important consideration when you're doing financial statement analysis. You need to make sure that we're generating sufficient cash from operations to be able to pay for our investing activities. Now that we have our ending cash balance, we can link it directly to our cash on our balance sheet. Yeah, I can link it here. And then that I can complete out my cash flow total assets. Okay, and this way I can also complete out my equity, and I can also complete out my total liabilities plus equity. So this model is complete at this point. So let's do a balance sheet check. Balance sheet check is that total assets should equal total liabilities plus equity. So if I subtract total liabilities and equity from my total assets, it should result in 0. Which it does, which means our model is prepared in a correct way. One thing to note is equity represents two things. Equity could be the amount of money that we invested in the business, which could be share capital, and or it could also be retained earnings. Let's for a second assume that all the equity that we have in the business is our retained earnings. Similar to the formula that we had for ending PBE, ending retained earnings is the beginning retained earnings plus net income minus dividends. It's the beginning retained earnings plus net income minus dividends. So if we assume for a second that all our equity is retained earnings, so let's calculate the retained earnings for year 1. So it's going to be net income for it's going to be the beginning retained earnings, which is going to be 530, plus net income minus dividends, which is 0. So you can see that for the year 1, our retained earnings happen to be 646, which matches exactly with our equity value for year 1. Okay, so this model is totally consistent. It's well laid out and shows you the interconnection between the income statement, the balance sheet, and the cash flow statement, and the logic that we need to follow to complete it out. This is like an intermediate model on 3-statement modeling. So if you like this video, please subscribe to my channel. I'll be posting more videos like this, more complicated concepts such as LBO and capital budgeting and much more. So hope you found this video helpful, and see you for the next one. Have a nice day.